Future trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello and welcome to Pasture to Pin, a new series by the Ever.Ag Insights team. Each week we bring you news and updates on the cattle markets with the intention of helping cattle producers manage their risk. I am your host, Todd Rowen, coming to you live from my home office in the Texas Panhandle, joined by my co-host and teammate, Mr. Trey Freeman. Before we get started, I will timestamp this episode. Today is Tuesday, June 20th, 4:11 in the afternoon. Instead of having a guest on this episode, Trey and I will be a cattle team dynamic duo, if you will, and we will do a deeper dive into the current state of the cattle markets and cattle complex. Mr. Freeman, how are you today, sir?
Doing great. Good to be here again, MT.
Good. Excellent, as always, to have you. What is the weather up like in Oklahoma?
It is hot and humid. We've gotten a little bit more rain here in the Panhandle. Moving further east, kind of central, just west of Oklahoma City. Certainly got some rain here the last week. It's hot, but grateful for these rains.
Yes, absolutely. Absolutely. Past couple weeks here in the Texas Panhandle, we have had limited moisture. Considering the whole month of May was anywhere from 12 to 20 inches. So maybe 2 to 3 tenths in the last couple of weeks. But bigger picture for moisture has been very, very nice. Looking at the most recent pasture and rangeland conditions report, which is a specific segment of the crop progress report, the Plains states have seen big improvements. The Dakotas primarily, Nebraska and Kansas a little bit behind the rest of the Plains states. Kansas, unfortunately, also an outlier. They still find themselves in drought-like conditions with some slight improvements over the last few weeks. The Rocky Mountain region is stark contrast to last year with much improved rainfall and much improved snowpack. Montana's pasture conditions sit at 87% fair to good, attributed mainly to excellent snowpack over the winter and much needed rains throughout the spring and into early summer. Some places have really only recently seen snow melt here at the beginning of June. These states were states that a year ago were just almost devastated by drought. I mean, there was no pasture conditions to speak of. So it's nice to see such a good recovery from these states. Mr. Freeman, please take us away with the futures market update, sir.
Futures, they're on the defensive. In 2 weeks, August fat cattle are $8.40 off the highs, and August feeders are $13 off the highs. Why is this? Well, we've entered a time of year when supplies for market-ready cattle increase on the year, and we're approaching the dog days of summer when demand for beef tends to soften. So futures, they're reflecting this. August fat cattle are currently sitting at 169.70 and technically don't have support until around 165. August feeder cattle are sitting right above the 50-day moving average at 231.60. This 50-day has not been breached since November of last year. A close below this opens the door down to 222. There's really not a whole lot of support on the charts after we breach that 50-day. Contributing to the sell-off in feeders has been the rally in corn futures. Corn and soybeans, they're now trading weather. In the same 2 weeks that feeders have sold off $13 a hundredweight, corn has rallied 50 cents in the July contract and 70 cents in the December contract. Now, moving forward, these weather markets and grains will continue to spill over into feeders, and fat cattle futures will continue to be comfortable trading at a sharp discount to cash prices, taking on a prove-it-to-me attitude. This has been the trend. I don't expect this discount to cash to change until we begin approaching the final quarter of this year when supplies of market-ready cattle start to decrease again on the year.
Very good. Thank you very much, Trey. Looking to the cash and fundamental side of the market, feeder cattle prices have backed off a little bit in the sale bar in the past few days, as well as for the CME feeder cattle index. The 7-day average was as high as 228.20 last week, but ended the week at 223.76. Cash live cattle have really traded sideways to a little lower the last week. Cattle in the north have traded at a range of 186 to 190 live and 296 to 300 dressed on very, very light volumes. Cattle feeders in the south passed on bids of 182 last week as they were able to secure 185 live the week before. So going into this week, it is a shortened week, just 4 days, but show lists in the north and south are starting off the week very, very light. Cutout values have also pulled back to start the week. Choice currently sits at 336.91, while select is at 307.93. That narrows the spread from last week a little over $3 to 28.98. Strong cutout values are going to keep packers in buy mode, but given the light show lists and rising temperatures as we head into summer, it is likely that the packers will pull their own cattle forward as well as their contracted cattle forward and be a little more selective on the cattle that they buy from the show lists. Again, with this heat, weights and grades will likely take a dip, especially in the south, as we're already battling triple-digit temperatures. Which could cause cash prices to converge closer to futures rather than futures rise higher to cash. So only time will tell. For our special segment, we will dive deeper into these markets. So at this point, Trey, let's take a step back to the big picture and see how deep we can get into these current markets. So let's start with the futures and what you're seeing on the futures side from a 50,000 foot view.
Yeah, looking at a rolling front month feeder cattle contract, we were trading 165 in feeders a year ago. Now we're trading 232. We shot up there to 245 relatively quickly. A pullback here, it seems awful drastic, but when you look at the big picture, $13 is not a whole lot. Looking at fat cattle a year ago on the same front month rolling contract, we're trading 130. Today, that June is trading 177, and that August trading 170. So in the grand scheme, that is quite the run up. Really, the fundamental supply situation is the big driver, but what has really caught the market off guard is the continued demand. And so, again, just looking at this at a 30,000 foot view, that's quite the run up and has exceeded a lot of expectations.
Very good, Trey. Before I switch to cash, you mentioned demand. Retailers have done a pretty decent job of absorbing these price shocks in the cutout as well as in the cattle. The average price of ground beef in the store is still below $5. I believe it's in the 490s, but it's still below $5. So retailers have really kind of helped us out, and demand has been very nice. Back to cash. Cash, to your point, Trey, cash has been on a very similar trajectory. Going back to 630 last year, the 7-day average of the CME Feeder Cattle Index was at 165.67. At the start of this year, on January 2nd, it was at 181.05, and currently it sits at 223.76. That's a year-over-year increase of $58.09 per hundredweight, and a year-to-date increase of $42.71 per hundredweight. The same is true for live cattle. The steer heifer 7-day average of the 5-area weighted average is currently at 184.63. A year ago, it was at 143.37, and at the start of the year, it was at 157.77. Year over year, that's an increase of 41.26 per hundredweight, and a year-to-date increase of 26.86. Now, Trey, given these increases, it's pretty much the general consensus that we are shaping up similar to 2015. I think you would agree with that. I would agree with that. But what in your opinion, what is similar? And if anything, what appears to be different?
Looking at a chart, there's a lot of similarities, very similar action. Now, last bull market, we had ample forage. This bull market, we had such an excessive drought, likely kicking the can down the road as far as herd expansion goes. Last bull market, we had extremely low rates. This bull market, we've seen one of the most hawkish rate markets we have seen. Lots of inflation, fears of recession. A lot of this was not around during that last bullish cycle.
Right. Agreed. And this is a very different environment, both physically from an interest rate perspective, as well as coupled with inflationary and recessionary concerns. So what can a producer do with this? What are Trey and I hoping to convey to producers today? Bottom line, we have had a historic run-up. So posing a question, why not lock in some of the highest prices of all time? These prices are great. Understandably, margins might not be there yet, but Trey and I would really urge producers to start considering how some of these factors could affect your operation and start thinking about how profitability some of your operations are. And as always, if you're curious about tools, please feel free to give Trey and I and our entire team a call. That is it for this episode of Pasture to Pen. Thank you to all of our viewers for watching this episode. If you haven't done it already, hit the like button, hit the subscribe button, and then click the bell to be notified of future episodes. Thank you, as always, to my co-host and teammate, Mr. Trey Freeman. Thank you again to Paige, as always, who makes us look our best. Thank you to Corey, and thank you to the entire Ever.Ag Insights team for making the show a reality. And as always, stay safe and pray for rain.